Yes, January Consumer Price Index out in a few seconds. All yields are a bit lower, and here we're hitting the wires. Headline number expected to be up 0.2% is up 0.3%. That's the hottest since SEP of 23 when it was up 0.4%. Strip out food and energy, even hotter, up 0.4%. Also 1/10 hotter than expected, up 0.4%. Well, you equal that going to May of last year. You surpass it going to April of last year when it was up 0.5. The year-over-year numbers also hotter, 3.1 on headline year-over-year. We were expecting 2.9, but did make progress versus the rearview mirror, which stands at 3.4. Now, if you consider 3.1, we've already been there. We were there in November of last year, and we were at 3.0 in June of last year. Finally, CPI year-over-year core, I think one of the ones I'm paying most attention to, 3.9%, exactly as the recent month, December 3.9, 0.2 hotter than expected, and 3.9 is the smallest year-over-year change since it was 3.8 in May of 21. Now, I don't always hit some of these indices, but I think it's important to hit it today. If you look at the headline actual index for CPI, it's 308.417. Which means that if you go back to 1913, we've never had this index higher than it is right there. And if you strip out food and energy and you look at CPI core, the actual index, this one is seasonally adjusted. The headline is not seasonally adjusted. This one comes in at 314.43, by far the biggest it's ever been, going back to record keeping in 1957. So these numbers are hot. Interest rates have zoomed up. These are now representing some of the highest yields of the year by far. 4.28 in a 10-year. We see pre-opening equities, of course, moving lower. And none of this should be shocking. And this is a cautionary tale for those, especially Fed speak, continually annualizing 3- and 6-month rates as if it's set in concrete. This set of numbers shows that is not true. And the biggest tail risk of any traders that I talk to seems to be higher inflation.
Okay, let's talk a little bit more about it. EJ, you want to weigh in on what you think's happening here and how big of a problem this is going to be for the economy, for the markets that have been waiting for a cut?
Well, in terms of the economy, I think this is a really big problem because what we've seen is M2, for example, not declining, not flatlining, but growing ever since October. The Fed is allowing it to grow because they're allowing all of this money to move out of sterilization to boost bank reserves. That's causing equities to go up, and it's also causing bank credit to expand. But, you know, the other thing that we have to really worry about here is the fact that the CPI is actually understating inflation. We talk about how there's this lag in housing and rents, for example, but we don't seem to be talking about the fact that the CPI is only measuring rents. Even the component of the CPI that tries to estimate the cost of home ownership still relies on rents. And because the cost of home ownership has risen 4 times as fast in the last 3 years as rents have, it has grossly understated the cost of home ownership. So instead of being up about 20%, it's actually up about 80%. But that's not coming through in these numbers.
Hey, Steve and Rick, let's say we're trying to figure out a scenario that makes Professor that we had on earlier. I don't know if you saw it, Rick, but Steve was referencing it. This is like the nightmare scenario, Steve. The professor thought that they're too tight right now. But let's say the economy just isn't cooperating, and neither is inflation. So they got to stay too tight for too long. Even though maybe they should be cutting, they stay tight, and eventually we get a slowdown or a recession. That's like a blast from the past, isn't it, where they can't get it under control, even though the conditions are already too tight. Is that how we get a recession eventually, Rick?
Well, listen, I think that the Fed keeping rates where they're at higher for longer is the right decision. I do think that there's certain aspects within the economy where prices are going to remain sticky. But the issue is, Joe, is that the Fed can't really help those areas. whether it's fire insurance, auto repair, the cost of autos, EV issues, all these things moving forward are not going to be slowed down in a dramatic way, no matter where the Fed pegs interest rates. Much of it is government policy, and government policy goes against economics, hence we have many of these issues. I think sticky inflation is going to remain, but I think it's a completely different animal than the type of inflation that we're most fearful of in the 70s.
Hey, Steve, I'll let you weigh in on that in just a second, but I want to get Skanda in because he hasn't weighed in yet. Skanda, go ahead. You respond to what you think on that question, too.
I think if we just take a step back into Steve's original point, January is always a pretty volatile month, but especially compare it to where we were 12 months ago, 6 months ago, even on the year-over-year comparisons, we made a lot of progress. It's true that this is a spikier print than what we've seen over the last couple of months, especially after releases have been revised. But nevertheless, I would say there's still broad trends of progress. It's true that you have seen maybe on the services side of CPI a little bit more strength for this month. Goods deflation is continuing. Rent is taking a while to actually feed in. But the progress on inflation has happened even as the labor market hasn't broken, and that is itself very good news. We'll see about the months ahead about progress. January and February tend to be especially volatile months. But I would be a little bit more careful about how to parse numbers around January and February in particular. These are especially volatile months where seasonal adjustment is doing a lot of the work alongside. This is obviously a place where prices tend to be raised around the turn of the calendar year. So I would just urge some level of caution and take a little bit of a deeper perspective about how these numbers are actually should be shaping how Fed policy should be set going forward.
All right, guys, just to sum it up, inflation came in for January 0.1% hotter than expected. This is bad because the economy has been waiting for a cut, and this pushes it back because inflation is not all the way gone. We're not on the deflationary path that we used to be. It's coming back just a little bit. This is making the yields jump and the stocks fall. We also are at risk to be too tight for too long, which puts us in recessionary risks if we go for too long. But the Fed can't help everything because of the government policies. So no matter what happens now, we're kind of in a bad pickle. We're just going to have to kind of ride it out and see how it goes. But this definitely means yields up, stocks down for the near future. Year on year, we're still making progress in inflation, which is good. But month over month, we're not looking so hot. We've got some food deflation still kind of happening. And we have the housing market that's still holding up. It hasn't fallen and crashed yet. Other than that, guys, we've got a hotter than expected report. And it's gonna be a rocky road in the stock market. Hope you guys enjoyed the video. Catch you in the next one.